Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Meharry. Thanks for tuning in. Ho, ho, ho! Merry Christmas! So since tomorrow is Christmas Eve, I decided to do the podcast a day early because, let's be honest, you guys don't want to listen to me on Christmas Eve. And so this year you get a Christmas Eve podcast. And I've always said that Christmas Eve is the most austere of holidays. And this podcast is also going to be a little bit different and probably a little bit shorter because, quite frankly, I'm not really feeling the whole work thing. You know, I kind of miss being in school when you have the entire week of Christmas and then the week after off. My brain still kind of operates on that schedule, to be honest. Yesterday was not exactly productive, and I don't have much hope for today beyond this podcast. Although I am fairly certain that I'm going to produce an amazing pecan pie this evening, which will be consumed on Christmas Day. Now, even though it's close to Christmas and I don't feel like working, I would be remiss if I didn't mention the fact that gold and silver are both surging again. As I sat down to prep for the show this morning, gold was over $4,500 an ounce, and silver had just nudged above $70 an ounce. And I think gold has fallen off a bit while I was prepping the show. I think it was a little bit below that $4,500 mark, but still another record. And gold just keeps surging higher and higher and higher. And this raises a question. Are precious metals in a bubble? Or is this rapid increase in the price of gold and silver, platinum, palladium, is it telling us something else? Is it signaling that we might be in the midst of a monetary paradigm shift? Reuters columnist Edward Chancellor thinks that's the case, and I think he makes a pretty compelling argument. And notice I said this is a Reuters columnist. This is about as mainstream as it gets. And we've got a guy publishing an article in this extremely mainstream publication talking about the fact that gold and silver are signaling this paradigm shift. This is something that I've been talking about for months and months. This rapid rise in the price of gold isn't just being driven by, speculation. It is being driven by something very fundamental that is going on in the economy. Now, when you have an asset swiftly rising in price, as we've seen with gold and silver, conventional wisdom holds that it's setting up for a fall, right? Everything that goes up must come down. And every time the gold price has fallen during this bull market that's been going on for basically 2 years now, mainstream pundits declare the air's coming out of the bubble, right? And then every time gold rallies again. Most recently, the mainstream declared the bottom was falling out when gold corrected in late October. But that downturn only trimmed about 9.8% from October's record high price. And, once again, we're now at a new record level of $4,500. So it was a very shallow correction, and it was a very short correction in terms of its duration. Of course, all this really proves is that right now gold bulls are resilient. It doesn't preclude a deeper correction. It doesn't preclude a deflating bubble in the future. But this resiliency could also signal that gold's rapid rise isn't just bubble behavior, right? And, I think corrections are inevitable. You always have corrections in a healthy bull market. And, we saw it in October. Both gold and silver became oversold, and they both corrected and then began to rally again. So, I would not be shocked to see more corrections in the future, even deeper corrections than what we saw in October. It's just natural in a market. But that doesn't mean that we're in a bubble and that the air's going to come out of the bubble and that we're about to enter into this long bear market period, which is what I'm seeing some analysts out there saying. And they often point to gold's bull market in the 1970s to kind of make the bubble case. You'll see it pointed out quite often that right now gold is at a very similar trajectory as it was in 1979. Of course, in 1980, we saw a rapid decrease in the price of gold in a long-term bear market. The price rose rapidly all the way through the 1970s, only to crash in the early 80s. And that was when Paul Volcker cranked up interest rates to 20% to slay the inflation dragon. And, with this action after its peak in late 1979, gold gave up nearly 2/3 of its price. So is that where we're heading, right? Or are we repeating that history? But, it's important to keep in mind this isn't the early 80s. And needless to say, no Volcker is waiting in the wings. The next Federal Reserve Chairman is likely to be even more inclined toward easy money than Jerome Powell. So I think it is at least wise to look at the current setup and ask ourselves, what message is the gold market and the silver market and all of precious metals too? I mean, we're also seeing very strong bull markets in palladium, platinum, rhodium, copper. So it's not just gold and silver, but it's important to kind of to at least consider that this might be something different than just a typical bubble. And Chancellor in his article notes that the gold market valuation tends to reflect different monetary regimes. And this is how he put it, quote, gold reset higher following the credit collapse of the 1920s and jumped in the second half of the 1970s as the so-called Great Inflation took hold. Over the next 2 decades, it remained in the doldrums as price increases abated and real interest rates remained high. After Alan Greenspan's Federal Reserve slashed interest rates in the early 2000s, gold enjoyed a long bull run. During the era of zero interest rates and quantitative easing from 2008 to 2022, the price was volatile, but its upward trend continued. Of course, then we can fast forward into the pandemic era where we had unprecedented easy money, nearly $5 trillion in quantitative easing, and we saw the price of gold rally yet again. And then, of course, we saw gold sell off and trade sideways throughout the early days of the Fed's tightening cycle once the central bank had to concede that inflation was not, in fact, transitory. So right now, we're seeing another shift in the price of gold. Is this signaling another paradigm shift in the monetary structure? Well, the yellow metal is certainly behaving differently than in the past. Conventional wisdom holds that the price of gold moves inversely to real interest rates. When we say real interest rates, we're just talking about the stated interest rate, right? So they'll say, interest rate's 3.5% minus the CPI, so minus inflation. It is the interest rate adjusted for inflation. That's the real rate. So if you go back to that era where we had 0% interest rates, the real interest rate was actually negative at that point. So historically, the gold price has dropped when long-term interest rates rise, since it is a non-yielding asset. It's just typical gold behavior. This is why we saw constant price pressure on the yellow metal in the early days of the Fed's monetary policy tightening in early 2022. Conversely, falling interest rates, like we're having now, tend to be bullish for gold. So in late 2022, there was a little bit of a shift. Gold began to break out of the doldrums despite falling inflationary pressures and rising inflation-adjusted bond yields. In other words, we had bond yields and interest rates going up and gold still rallying at the same time. This is unusual, not typical behavior. In other words, the bull market picked up speed during a period when market dynamics should have been driving the price lower. Wisdom Tree at the time noted this disconnect, saying that investors were beginning to perceive higher rates as bearish. Portfolio managers were, quote, beginning to re-engineer portfolios for an era of structural deficits and active fiscal policy. In other words, portfolio managers were beginning to re-engineer portfolios to deal with a new monetary regime. Quote, the asset's behavior has evolved. What was once a rate-sensitive trade has become a fiscal risk hedge. Correlations with Treasury yields have flipped from deeply negative to positive, implying that gold now rises with, not against, higher long-term rates when those rates reflect sovereign stress. This is an inversion of an old mental model. It's a paradigm shift. So what happened that might account from this divergence from conventional wisdom? Well, the U.S. and its allies aggressively sanctioned Russia after it invaded Ukraine, and that's really when you started to see gold take off. And then, in the spring of 2024, the Biden administration threatened to liquidate and sell some $300 billion in frozen Russian assets. And this is what I call the weaponization of the dollar, and it drove gold to fresh record highs. Using U.S. bonds and the dollar as a foreign policy billy club could certainly incentivize other countries to behave, but it also sends another message: get out of dollars while you can, right? Chancellor describes the impact of these moves. Quote, the act shook the foundation of the international monetary system in which the U.S. dollar had long served as linchpin. Reserve managers at a number of central banks started looking for an asset that could not be seized and was not the liability of another sovereign. They returned to the original reserve asset, gold. And of course, as you know, central banks have been aggressively buying gold for the last 3 years. We've seen central bank gold buying over 1,000 tons for the last 3 years. To put that into context, central bank gold reserves increased by an average of just 473 tons annually between 2010 and 2021. So central bank gold buying has effectively more than doubled over the last 3 or 4 years. So, you might look at the sudden surge in central bank gold buying and call it a bubble, but Chancellor noted, quote, the irrational exuberance that normally accompanies a mania is absent. In fact, it's interesting because, we have seen central bank gold buying fall off a bit this year as prices have gone into record territory. But central banks are still buying. And if you look at the analysis by the World Gold Council, they're constantly saying that these central banks are buying strategically. They're not buying based on market conditions. This is a strategic move, and it tends to be rather price insensitive. And in fact, the last 2 months, we've seen the strongest levels of central bank gold buying of the entire year. Chancellor writes, speculators are too busy obsessing about cryptocurrencies and anything related to artificial intelligence to pay much attention to the barbarous relic. So kind of making the case that it's not necessarily, a bubble situation where you've got this, everybody's buying tulips because they want tulips. And Chancellor also noted that, despite the record prices, ETF gold holdings are still about 10% below the 2020 pandemic peak. So this also doesn't exactly describe, a manic bubble. Gabelli Gold Fund portfolio manager Caesar Bryan pointed out that the 1970s gold bull market was extremely volatile with several significant reversals. Knowing this history, investors hold their breath every time gold corrects. But so far, these corrections have recovered quickly. And Bryan said, this time just, quote, feels different. As Chancellor noted, the monetary and fiscal background today couldn't be more different than the 1970s. And again, that's what a lot of people are comparing this to. He wrote, at the end of the 1970s, the United States was a significant international creditor. Today, it is the world's largest debtor. Back then, U.S. government debt was around 30% of GDP. Today, it is nearly 4 times higher. For the past 3 years, the U.S. fiscal deficit has averaged around 6% of GDP, roughly 4 times higher than the budget shortfall in 1979. In other words, we have more debt, more borrowing, and more spending than we did even in the 1970s. Chancellor swerved into another reason for this recent de-dollarization trend and the pivot to gold. The U.S. government keeps right on borrowing and spending despite a $38 trillion debt. Last month, the federal government posted a $173.28 billion deficit despite a massive increase in tariff revenue. We keep hearing about how tariff revenue is going to pay for dividends and, get rid of the IRS and pay off the national debt. No, we're running these massive new influxes of tariff revenue and still operating with huge deficits. Again, At some point, you stop loaning money to your drunk uncle. And I should also mention here that we have a central bank that seems determined to cut interest rates into this inflationary environment. I've talked about this ad nauseum. They have to cut rates, even though we still have persistent inflation, because we have a giant debt black hole that warps the entire economy. This economy can't function even in a moderate interest rate environment. And the easy money spigot is really going to open up once President Trump gets his man in position as the Fed chair. It's a given that Donald Trump is going to pick somebody who is favorable toward more easy money. And please don't come at me with the, no, Mike, inflation is beat. Didn't you see the CPI? That November CPI report was as useless as the ugly sweater Uncle Herman is going to give you for Christmas. I wrote an in-depth article explaining how they basically just made up the CPI data. And I'm not going to go over all of that here today in the show. It would take forever, but I'm going to link to a couple of articles over in the show notes over at moneymetals.com/news, along with the report that gives an accurate measure of inflation, which is actually increasing at an accelerating rate. And just remember this, no matter what the government report says, inflation is here to stay. It is the stated policy. Right? Inflation isn't bad. They want inflation. They just don't want so much inflation that it makes you mad. So even when inflation is quote unquote under control, they're still devaluing your money 10% every 5 years. That's the stated plan. So anyway, in his Reuters column, Chancellor sums up this current environment. He said, quote, "It's not unreasonable to conclude that the rising gold price," and I would add silver and the other precious metals, "that this reflects a host of fiscal, financial, and geopolitical uncertainties." So that's not going to go away. This is what I keep talking about. It's about the fundamentals, right? What is driving all of this? Yes, we're going to see corrections. We're going to see the price of gold and silver fall. You know, there's going to be news that's going to change the trajectory of the markets for certain amounts of time. But fundamentally, this is the environment that we're living in. This is the new paradigm. And gold is the security in this crazy time. And, it's interesting because we're talking about a paradigm shift here, and we've seen it happen with central banks, but it's not complete, right? Central banks have aggressively bought gold, but most investors, particularly in the West and here in the United States, hold very little gold in their portfolios, relatively speaking. And Chancellor calls this a, quote, costly mistake. He said, quote, "According to Goldman Sachs, the optimal portfolio over the last 10 years would have held half of its assets in gold. Most U.S. investors only hold a handful of gold, if any at all. However, that paradigm may be shifting as well, and what was described as a, quote, seismic shift. Morgan Stanley CIO Michael Wilson recently came out with an investment strategy that includes a 20% allocation to gold. Right? I've talked about this before. Historically, the conventional wisdom on Wall Street was you want a 60-40 portfolio. You got 60% of your holdings in equities, 40% in fixed income investments such as bonds. Given the changing market dynamics, Wilson said investors should now consider a 60-20-20 strategy, swapping half of that bond portfolio for gold to serve as, quote, a more resilient inflation hedge. He said, quote, "Gold is now the anti-fragile asset to own rather than treasuries. High-quality equities and gold are the best hedges." And since Wilson floated this idea, the 60-20-20 allocation scheme has received increasing attention in the mainstream financial media. So there's some momentum behind this idea. It's not just one guy that came out there and said that. As important as, a guy with a company this big is. If the idea gains widespread acceptance, it could push gold to even loftier highs, right? Because the average allocation to gold in most portfolios today is under 1%. Investors would need to buy a lot of yellow metal to boost their gold holdings to 20%. And think about it. Even if they go to 2 or 3%, that's a lot of gold being bought by investors on top of the central bank gold buying. So, yes, in conclusion, it is possible that gold is in a bubble. but it's probably not. The fundamentals seem to argue otherwise. It's more likely that this historic gold bull market and this historic silver market, platinum, palladium, copper, it's telling us something, and we would be wise to listen. I just realized that I never thanked you for listening to the show. I usually do that closer to the top, but I'm going to give myself a little pass on that because it's almost Christmas, right? My brain's not working today. But I really do appreciate the fact that you listen to the show. Thank you so much. And as always, if you would do me a favor, think of it as a Christmas gift. Go out and share this episode. Maybe this isn't the best episode to share, but no, share the episodes. Give us those 5-star ratings. Give us those thumbs up wherever you listen to the podcast. It helps boost the algorithm. It helps spread the show. If you think it's valuable, other people that you know certainly probably would as well. So I just said certainly, probably. Parse that out. Anyway, again, thank you for watching this show. Now, I said you'd be wise to listen to what gold and silver are telling you. Speaking of being wise, have you finished your Christmas shopping yet? Now, I'm proud to say I have. I have historically been kind of that last minute guy. In fact, when I was younger, I used to actually like to go to the mall. Back when the mall was like the center of shopping. I used to like to go to the mall on Christmas Eve. And get those last minute gifts and then watch all of the other panicked shoppers. I'm not doing that again. As I've gotten older, I've become more and more of a hermit, right? Too people-y out there. So I have finished my Christmas shopping, but I'm sure a lot of you folks are looking for last minute gifts. And if you're still trying to figure out those last minute ideas, how about a gift fit for a king? I'm talking about gold. And I think most kings would probably find silver appropriate at $70 an ounce as well. So gold and silver. And we have a page on our website that has some wonderful gift ideas that you can peruse. If you go to moneymetals.com, it's right on the top of the page. You just click there. It'll take you to that page, and you'll find a lot of really good ideas that you can get your loved ones, gold and silver, right? They're not going to return the gold and silver. Well, they might when they, need to buy something else because gold and silver are real money. But they're not just going to throw it in a drawer and never use it, right? Gold has long been a symbol of royalty. It represents wealth. It represents power. In ancient cultures, gold symbolized wisdom. And this is why the Magi presented Jesus with the gift of gold, along with frankincense and myrrh when they visited, according to the biblical account. And of course, all three of these gifts hold deep symbolic meaning for those of us who hold the Christian faith. As I mentioned, gold represents Christ's position. He's the King of Kings. And gold is a gift fit for a king. In fact, gold was often presented to kings in ancient cultures. As for the other two gifts, frankincense is an incense that was used in worship. So this represents Christ's divinity. And myrrh was used for embalming, which was kind of prophetic. It pointed toward Christ's humanity and prophesied his eventual death on the cross. So if you have any Christian background at all, and probably even if you don't, because you live in the United States where Christianity is kind of intermeshed in popular culture, you probably know the story of the three wise men or the three Magi. They were actually probably Persians. They may have been royalty. They may have been scientists. There's a lot of speculation that they were astronomers. But for whatever reason, they were aware of the prophecies that a king would be born in the land of Israel, in the land of Judah. And they saw this star and they followed it because they wanted to see this king. And so they brought these gifts before the king to present to this newborn king. And here's something that you may not know. These gifts, they still exist. We have them. Based on church tradition, the gold, frankincense, and myrrh are currently in the monastery of St. Paul, which is out on Mount Athos in Greece. Mount Athos is a holy mountain where there are a lot of monasteries. It's considered a very sacred place. Church tradition holds that Mary actually visited Mount Athos. So, how did the gold and frankincense and myrrh end up there? Well, based on historical accounts and church tradition, Mary kept the gifts in her care for most of her life. And as she neared her death, she entrusted the gold, frankincense, and myrrh to some trusted women in the church at Jerusalem. And they remained in that city until the reign of Emperor Arcadius. And he was the emperor between 395 and 408 AD. And recognizing the religious significance, Arcadius transferred the sacred relics to the capital of the Eastern Roman Empire, which at the time was Constantinople. And they were placed there for public veneration. The gold, frankincense, and myrrh became symbols of the Eastern Roman Empire's commitment to the Christian faith. And the relics remained there until 1204, which was the year of the Fourth Crusade. And at that time, the Crusaders sacked Constantinople. And as the army approached, the gifts, along with other holy relics, were moved to Nicaea for safekeeping, and they remained there for about 60 years. Nicaea was a refuge for the exiled Byzantine court and a symbol of resistance against the Crusaders. Once the Crusaders moved on, Emperor Michael Palaeologus, these Greek names are not easy for me. Palaeologus, I believe, is how it's pronounced. He returned the gold, frankincense, and myrrh to Constantinople, where the gifts remained until the city fell to the Ottoman Turks in 1453. Now, as fate would have it, Sultan Murat II was married to a Serbian woman who was a Christian. And she came into possession of the gifts and eventually presented them to the St. Paul Monastery, where they have been preserved to this day. So you can actually, if you go to Mount Athos, you can see the gold, frankincense, and myrrh. So what does the gold look like? Well, it's formed into 28 flat tiles of various shapes. So some are rectangular, there's some that are trapezoids, there's some that are like polygons, and they're all carved with very intricate designs. And the tiles are each around 2 by 3 inches. Of course, it's hard to get exact dimensions with some of these irregular shapes, but from a rectangular standpoint, about 2 by 3 inches is the size of these tiles. So I wanted to figure out exactly how much gold we're talking about, but I couldn't find any source with that info. I haven't been able to find anything where they actually weighed this gold. So ChatGPT and I tried to guesstimate, and we made some educated guesses about the thickness. We assumed it is 24 karat gold, and Mr. GPT and I came up with about 240 ounces if the plaques are close to being solid. They don't really look like they are. And giving their non-rectangular shapes, we know that the measurements may be off a bit. So let's just say 200 ounces, just as a kind of a guess. So if we price that out at $4,500 an ounce, that's worth about $900,000. So not a bad gift for a baby, right? But for a king, yeah, probably pretty appropriate. As I said, gold is a gift fit for a king, and you can still get some. Right? All you got to do is go to moneymetals.com and click that link to find the great gift ideas. If you woke up today and saw, oh my gosh, gold is at $4,500 an ounce, silver is at $70 an ounce, maybe I need to get in on this. You can. All you got to do is call 800-800-1865. Talk to a Money Metals, precious metals specialist. They'll answer any questions you might have. They'll help you understand how gold and silver can fit into your investment strategy. If you're sitting there and you're thinking, man, I don't have $4,500 to buy a 1 ounce gold coin, hey, that's okay. We actually have a way that you can accumulate gold and silver over time with our monthly installment plan. It costs as little as $100 a month. One of our precious metal specialists can tell you about that as well. But you got to start by making the phone call. Do it today, 800-800-1865. If you don't want to talk on the phone, that's cool. You don't have to. You can actually go to moneymetals.com and chat with a precious metals specialist right online, or you don't have to talk to anybody. You can just go to moneymetals.com, pick out what you want, buy it. We'll ship it to you. Or if you want to store your metal in our state-of-the-art bullion facility, we can set that up for you as well. But again, you got to make that phone call. So don't wait. Do it today. Get those last-minute Christmas gifts for your loved ones, those gifts that are fit for a king. And while you're at it, get yourself some real money. that will protect you from this relentless devaluation of the dollar. So we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get much more information about everything I talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver in your inbox, sign up, get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you can also tune into our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with interviews between yours truly and interesting people in the world of silver, gold, economics, and investing. So again, thank you so much for listening to the show. I really do appreciate it. Give us those thumbs up, share the episodes, write those nice reviews, and I hope you have a very, very Merry Christmas. And I will be back again next week to wrap up the year. How about that? So thank you so much, and again, Merry Christmas.